We are not financial advisors. The content on this YouTube videos are for educational purposes only and merely cite our own personal opinions. In order to make the best financial decision that suits your own needs, you must conduct your own research and seek the advice of a licensed financial advisor if necessary.
Hey there, folks. Welcome back to our channel. Today, we're diving into the world of investing and discussing a three-fund ETF portfolio consisting of VU, BND, and an international ETF. We'll be sharing our thoughts on this investment strategy, and we'd love to hear your feedback. This approach can help you build a well-rounded portfolio without the need for complex trading strategies or constant monitoring. Remember, investing is all about finding the right balance between risk and reward. By diversifying your portfolio with these three funds, you're taking a step towards a more balanced investment strategy. Now, let's talk about the three-fund ETF portfolio. This investment strategy is a simple and low-cost way to build a diversified portfolio. It's a great starting point for beginners, and it's also a solid option for more experienced investors. The VU fund is a popular choice for those looking to invest in the S&P 500 index. This index represents the largest 500 companies in the US, so it's a great way to gain exposure to the US stock market. The BND fund, on the other hand, is a great option for those looking to invest in the US bond market. This fund tracks the Barclays Aggregate Bond Index, which is a broad measure of the US bond market. Finally, the international ETF is a great way to diversify your portfolio even further. This fund tracks a broad index of international stocks, giving you exposure to companies from all around the world. Now, let's talk about the ideal allocation for this three-fund ETF portfolio. A 60/20 split between stocks and bonds is a popular choice, with 60% of your portfolio invested in VU and 20% in BND and 20% in international ETF. However, you might want to consider increasing your bond allocation to 50% and equity allocation 25% VU and 25% international ETF if you're closer to retirement age or have a lower risk tolerance. Now, we know that investing can be a complex and intimidating topic, but we hope that this simple three-fund ETF portfolio has given you some food for thought. We'd love to hear your thoughts and feedback in the comments below. Remember, investing is a personal journey, and what works for one person might not work for another. So, do your research, consult with a financial advisor, and make the best decisions for your own financial future. Right, so to begin, this will be the exact strategy that I use for my own money, and it only requires 3 different funds. But before we go into what those are, you need to have a basic understanding of the way they work. In general, most ETFs are made up of a collection of various assets held within it that you can invest in collectively as a single unit. So when you buy one share of an ETF, what you're really buying is a tiny piece of ownership in all of the stocks within that fund. This allows you to immediately diversify across hundreds, if not thousands of companies with just a single purchase. And the best part is that each ETF has its own ticker symbol that tells you exactly what it tracks. For example, SPY is an ETF that tracks the S&P 500. So if I were to buy one share of SPY, I would essentially be buying a tiny piece of ownership in 500 of the largest companies in the United States. VTI is another ETF that tracks the entire stock market, from large cap to small cap. So this gives you even more comprehensive diversification across nearly 4,000 different stocks. And VXUS is an ETF that holds the largest global stocks from around the world. So this provides international exposure outside of the United States. The benefit of investing this way is that your portfolio will instantly match the performance of the underlying index that it tracks. This makes it pretty much impossible to lose money as long as you stick with these 3 funds. And you also have the added benefit of a readily diversified portfolio that you could care less about market timing or trying to pick individual stocks that could potentially outperform. Although before we go into which funds I would choose, let me explain something else really important. Most brokerages, like Vanguard, Charles Schwab, or Fidelity, allow you to buy fractional shares of an ETF, meaning you don't have to have tens of thousands of dollars to invest. You could realistically start with as little as $50 and gradually grow from there. This is also beneficial because it lowers the barrier to entry and allows you to take advantage of dollar cost averaging over time. After all, no one has any idea what the market's gonna do next week or even next year. So buying a little bit every single month helps to automatically take care of that without having to worrying about it. Anyway, as far as which funds to choose, this is a very easy 3-step process that anyone could follow. First, choose SPY or an S&P 500 fund. This represents large cap US companies and throughout the last 100 years, it's delivered an average annual return of 10.5%. So historically, this is about as good as investing gets. Second, choose VTI, or a total stock market fund. This includes everything from large cap to small cap companies, both in and out of the S&P 500, that tend to deliver a slightly higher return than SPY at an expense of slightly more risk. So I think it's a perfect complement to add some additional growth potential to your portfolio. And third, choose VXUS or a global ex-US fund. This is made up of non-US companies and it helps to further expand your portfolio to include international exposure outside of the United States. Historically, this has been one of the better performing asset classes over the last decade, and it's a great way to balance out the rest of your portfolio. From there, you want to decide on what percentage you want to allocate towards each of them based on your own personal goals and risk tolerance. The traditional approach is to put 60% towards stocks and 40% towards bonds. However, since we're talking about a 3-fund portfolio, it's actually more efficient to allocate 70% towards stocks and 30% towards bonds. But before we go into the exact breakdown, keep in mind that I'm not a financial advisor. This is not financial advice and nothing in this video should be construed as such. Although according to Investopedia, this is how much you could expect to earn with a well-balanced 3-fund portfolio over the last 40 years. On average, you could expect to see between 8 to 11% annually with a 70-stock, 30-bond portfolio, that's 9% compounded annually. Or if you had an aggressive portfolio with 100 stocks, you could have seen returns as high as 12% annually or 10.4% compounded. Now here's where things get really interesting. According to this same chart, even if we look back to the worst years on record, a 70-stock, 30-bond portfolio still managed to produce positive returns 20 of the time. So even during the worst of times, you'd still be making money at least 2 years out of every 5. Of course, past performance does not guarantee future results, but it's nice to know that over the last 40 years, this has proven to be one of the safest ways to invest your money. As far as my own personal allocation, I tend to agree with this 70-30 stock to bond split. Even though stocks have higher upside potential, bonds tend to stabilize your portfolio during downturns, allowing you to buy in at lower prices while keeping your portfolio in the green. Although since we're focusing on a 3-fund portfolio, you could simplify this even further and just buy a CHD, VTI and VXUS. This covers the entire stock market from large cap to small cap in the US and abroad, while paying a 3% dividend yield. And it's also one of the cheapest ETFs to own with expense ratios below 0.1%. From there, we got bonds. Personally, I'm a fan of BND or a Barclays Aggregate Bond Fund. This holds a variety of different bonds of varying lengths to maturity, making it relatively safe and stable. Plus, it has a low expense ratio of 0.05% and an average credit rating of AA-. And then finally, we got cash. I prefer to keep a portion of my portfolio in cash in case there's a fire sale or a once-in-a-lifetime opportunity that presents itself where I could deploy that money for maximum benefit. Although one thing worth noting is that cash tends to be the worst performing asset class, so you'll want to keep this to a minimum and only hold what you need for the next 3 to 6 months. So when you combine these 3 together, this is what our hypothetical portfolio looks like. As you can see, we have 70 allocated towards stocks with 30 towards bonds, and within those 3 stock ETFs, we have 66% allocated towards the S&P 500, 24% towards total US stocks and 10% towards international developed markets. This means our portfolio is well diversified, covers the entire stock market from large cap to small cap, and it yields about 3% without having to worry about individual stock selection or trying to time the market. Now beyond this, I personally like to reinvest all of my dividends back into my portfolio as additional shares of each of the funds. That way I could continue to buy more and more shares over time and increase my overall holdings without having to manually reinvest them myself. That way, Hopefully I'll be able to spend my 70th birthday partying on a yacht in St. Tropez with a beautiful woman half my age. Just kidding. Maybe I'll settle for a trip to Home Depot, but either way, I'll leave that up to you. Long story short, this is the exact 3-fund portfolio that I'm going to use for my own money, and it's one of the easiest ways to invest without having to worry about anything else other than dollar cost averaging consistently over time. So with that said, you guys, thank you so much for watching. Also make sure to subscribe, hit the like button if you enjoyed the video. Let me know which fund did you enjoy the most down below in the comments, and until next time.